Mia was 27, earning $58,000 a year, and felt like she was doing okay. She paid her bills on time, had a little savings, and even put a small amount into her employer's 401k. But outside of that, zero investments. She'd heard people talk about the stock market but had no idea where to actually start. Then a coworker mentioned something called a brokerage account. And that one conversation set off a chain of events that would change her financial future. Today, we're going to walk through exactly what a brokerage account is, how it works, and what Mia learned along the way. So what exactly is a brokerage account? Think of it as a special account, not a bank account, that lets you buy and hold investments like stocks, ETFs, bonds, and mutual funds. A broker is simply a licensed company that acts as the middleman between you and the financial markets. When Mia first heard this, her reaction was, "That's it." And honestly, yes, that's the core idea. You open the account, deposit money, and then use that money to purchase investments. It sounds simple because it is. The complexity people imagine usually melts away once you actually see how it works. Here's something Mia got confused about at first, and it's a common mix-up. A bank account and a brokerage account are fundamentally different tools. Your bank account, checking or savings, is FDIC insured up to $250,000, which means your deposits are protected by the federal government. But growth is minimal. A high-yield savings account might return 1 to 5% annually. A brokerage account, on the other hand, gives you access to market-linked investments that have historically returned significantly more over long periods, but without FDIC protection. All investments carry risk, and your balance can go down. These accounts serve different purposes, and smart wealth builders tend to use both. This is where Mia's eyes lit up, because she didn't realize there were different types. The most common is a standard taxable brokerage account. You can deposit as much as you want, withdraw anytime, but you'll owe taxes on gains. Then there are tax-advantaged accounts. The traditional IRA, where contributions may be tax-deductible and growth is tax-deferred. The Roth IRA, where you contribute after-tax money but qualified withdrawals in retirement are tax-free. And the 401k, which is employer-sponsored. For 2024, IRA contribution limits are $7,000 per year, or $8,000 if you're 50 or older. Mia already had a 401k, but she'd never opened a taxable brokerage account or a Roth IRA. Once Mia had her account open, she asked a great question. What can I actually buy in here? The chart on screen shows the average historical annual returns for different asset classes based on long-term data. Stocks, represented here by the S&P 500, have historically averaged around 10% annually over the long run before inflation. Bonds have averaged around 5%, and a basic savings account has often lagged behind inflation entirely. This is the chart that made Mia realize why so many financial educators emphasize investing in diversified, low-cost index funds. Past performance doesn't guarantee future results, but the historical data is worth understanding. Mia was relieved when she saw how simple the process actually is. Step 1. Choose a reputable broker. Look for SIPC-insured firms. The Securities Investor Protection Corporation covers up to $500,000 in securities if a broker fails. Major online brokers today charge zero commissions on stock and ETF trades. Step 2. Provide your personal information, name, address, social security number, and employment details. Step 3. Link your bank account and transfer funds. Many brokers allow you to start with as little as $1 using fractional shares. Mia transferred $200 to start, not because that's a magic number, but because it felt manageable and got her in the game. Here's the data that truly shifted Mia's perspective. This is the S&P 500 index over the past 2 decades. Notice those sharp drops. 2008 during the financial crisis, 2020 at the start of the pandemic, 2022 during the rate hike cycle. They look terrifying in the moment, but zoom out, and the long-term trend has historically moved upward. Someone who invested in a low-cost S&P 500 index fund in 2005 and simply held through every dip would have seen significant growth over time. This is why many long-term investors use brokerage accounts to hold diversified index funds and practice patience, not stock picking or market timing. Here's the number that stopped Mia cold. If she invested just $200 a month, the same amount she transferred to open her brokerage account, into a diversified portfolio averaging 7% annually over 30 years, she could accumulate an estimated $349,000 based on compound interest calculations. That's roughly $72,000 in actual contributions and over $277,000 in potential growth. Of course, market returns vary, and this is a mathematical illustration using compound interest, not a guarantee of any specific outcome. But for Mia, seeing the math laid out like this made one thing crystal clear. Time in the market tends to matter more than timing the market. One thing Mia hadn't thought about was taxes. In a taxable brokerage account, the IRS wants its share. If you sell an investment you've held for less than 1 year, any profit is taxed as ordinary income, which could be as high as 37% depending on your bracket. But if you hold for more than 1 year, you qualify for long-term capital gains rates, 0, 15, or 20%, depending on your income. For most middle-income Americans, that rate is 15%. Dividends are also generally taxable. This is one reason why many investors prefer to hold tax-efficient index funds in taxable accounts and keep higher dividend or bond investments inside tax-advantaged accounts like IRAs. Mia almost made every one of these mistakes. She waited 6 months to open her account because she thought the market was too high. That delay cost her months of potential compounding. She also considered buying a single tech stock she'd seen trending on social media, which carries significantly more risk than a diversified fund. And when the market dipped 3 months after she invested, her first instinct was to sell. Instead, she remembered the long-term chart we just looked at. She held. For anyone starting out, these 4 tendencies, waiting, concentrated bets, ignoring fees, and panic selling, are among the most common wealth-building obstacles financial educators highlight. Here's one more chart worth understanding, and it's something Mia learned about from a fellow investor in an online community. Expense ratios are the annual fees a fund charges, expressed as a percentage of your investment. This bar chart compares the long-term impact of a 1% expense ratio versus a 0.03% ratio, which is typical of many low-cost index funds, on a $10,000 investment over 30 years at 7% average annual growth. The difference is striking. Higher fees quietly compound against you, just like returns compound for you. Many financial educators consistently point to low expense ratios as one of the most controllable factors in long-term investing outcomes. Today, Mia has a Roth IRA and a taxable brokerage account. She contributes $200 a month and has stopped watching the market daily. She's not where she wants to be yet, but she's finally in the game. Her progress didn't come from luck or advanced knowledge. It came from understanding how these accounts work and applying a few straightforward principles consistently. A brokerage account is simply a tool. How you use it, and whether you start at all, tends to make all the difference over time. Here are your 4 takeaways. Open an account, understand your account type, keep fees low, and stay patient through volatility. Everything in this video is for educational purposes only and does not constitute financial advice. The examples and projections shown are illustrative and are not guarantees of any specific investment outcome. All investments carry risk, including the possible loss of principal.